Ever wonder why the wealthy seem to play by different financial rules? The truth is they do. Today, I'm pulling back the curtain on their secret playbook. I'm about to reveal 7 smart assets that look brilliant on paper, but secretly keep you poor. These aren't obscure investments. They're the exact ones your financial advisor recommends, your family swears by, and you probably own right now. Warren Buffett exposed this years ago. What the wise man does in the beginning, the fool does in the end. While average investors chase these popular assets, the truly wealthy avoid them like poison. The financial industry won't tell you this because these smart investments are their most profitable products. Each represents a critical misunderstanding about how wealth is built versus how most think it's built. The last asset I'll reveal is the most dangerous, combining emotional appeal with financial destruction. It separates those who achieve lasting wealth from those who remain financially stressed despite decades of hard work. Stay until the end. This information could save you hundreds of thousands and finally put you on the path to true financial freedom. You've heard this before. Buy property. It's always smart. Your father said it. Your neighbor repeats it. Even your financial advisor nods. Yes, real estate can build wealth, but there's a dangerous illusion hiding behind this belief. If that property isn't putting money in your pocket monthly, it's not an asset. It's a financial anchor painted gold. The average American spends over $9,000 yearly on hidden ownership costs, maintenance, taxes, insurance, HOA fees before the mortgage. Over 10 years, that's $90,000 gone. If the property doesn't appreciate or generate cash flow, it's not building wealth. Ask, will this put money in my pocket, or just give me something pretty to look at? A second home might sound like freedom, but if it drains money and time, it's a burden with a view. Take Mike from Chicago, who bought a mountain cabin. 5 years later, he'd sunk $50,000 into upkeep. Meanwhile, his colleague Sarah invested the same in a rental generating $600 monthly after expenses. The difference? Sarah's asset pays her. Mike pays for his. The wealthy buy properties that pay them, evaluating cash flow first, appreciation second. Platforms like Roofstock or Fundrise can help find income-producing properties. If you're stashing cash in a traditional savings account for safety, that safety costs you thousands yearly. The average savings account pays under 0.4% interest, while inflation runs over 3%. Your money loses value sitting there. A $10,000 savings over 5 years earns $200 interest, but loses $1,500 to inflation. Janet kept $50,000 in a traditional savings for a decade, losing $15,000 in purchasing power. Her brother Tom moved his to a high-yield account, 4.5%, and gained. Solution? Shift to high-yield savings, 4% plus, or money market accounts. Online banks like Ally or Marcus offer better rates. For long-term savings, consider I-bonds. Society tells you you've earned it, but a new car in retirement is often a financial setback. The average new car loses 15 to 20% of its value the moment you drive it off the lot. Within 5 years, it's lost over 50%. A $50,000 SUV becomes $22,000, a $28,000 loss. Invested conservatively at 7%, that $28,000 could grow to $55,000 in 10 years. Jim bought a 2-year-old model for $35,000 instead of $50,000. 5 years later, both cars had similar values, but Jim's savings grew. Smarter alternative? Buy a 2 to 3-year-old car with low mileage or lease if you prefer new cars. Owning a business isn't freedom unless it runs without you. 20% of small businesses fail in the first year, 50% by year 5. Even successful ones often become full-time jobs with more stress. Maria opened a bakery, successful but working 70-plus hours weekly, no vacations. David started a property management company, built systems, hired staff, and now takes 2 months off yearly while it generates income. The difference? Systems. Before starting, map core functions, operations, sales, finance, and delegate. Read the E-Myth Revisited or Built to Sell. If you can't take a 2-week vacation without chaos, you've built a job, not a business. It sounds perfect, insurance and investment combined. But a $500,000 policy might cost $400 yearly for term life or $4,000 for whole life, 10 times more. Most of that difference goes to fees and commissions. When you die, your family gets the death benefit, not the cash value you've built. Paul paid $650 monthly for 20 years, $156,000 total. His cash surrender value was $98,000. His brother Mark bought term insurance, $50 monthly, and invested the difference in an S&P 500 index fund, growing to $380,000. Buy term life and invest the rest yourself. Your aunt swore by it, your grandmother collected it, and every culture celebrates it. Gold jewelry as a safe investment. But here's the harsh reality. That beautiful necklace or bracelet isn't a wealth-building tool. It's a luxury purchase with a 200 to 300% markup, disguised as financial wisdom. When you buy gold jewelry, you're not just paying for the gold itself. You're paying for the brand name, the craftsmanship, the retail store's overhead, and the jeweler's profit margin. A $3,000 investment-grade necklace might contain only $800 worth of actual gold. The rest is essentially a fashion tax. Even worse, the moment you walk out of the store, that jewelry loses 30 to 70% of its resale value. Why? Because buyers only care about the melt value, the raw gold content, not the sentimental or aesthetic value you paid extra for. Take Susan from Dallas, who spent 30 years collecting high-end gold jewelry worth $25,000 at retail prices. When she needed cash in retirement, jewelers offered her just $7,600, less than a third of what she paid. The cruel lesson? That heirloom quality piece you overpaid for is worth little more than its weight in a smelter's furnace. If you truly want gold as an inflation hedge or portfolio diversifier, skip the jewelry store. For physical gold, stick to certified dealers like APMEX or JM Bullion, focusing on coins or small bars with minimal premiums. Always verify dealers through the Better Business Bureau to avoid scams. For convenience, gold ETFs like GLD or IAU let you invest without storage hassles. And remember, jewelry has emotional value, but never mistake it for a financial asset. Buy it because you love it, not because you think it'll fund your retirement. You've been there. A loved one is in a tight spot, and you have the savings to help. It starts with promises like, "I'll pay you back next month," or "This is just temporary." But here's the uncomfortable truth. 46% of personal loans to family or friends end in either lost money, damaged relationships, or both. Bankrate data. Without a contract, repayment timeline, or even a clear agreement, that loan often morphs into an awkward gift laced with resentment. And when payments stop, you can't send collections. You just simmer quietly at family dinners while they post vacation photos online. Consider Robert, who lent his brother-in-law $30,000 for a can't-fail business idea with just a handshake deal. 5 years later, after only $2,000 in repayments, the business collapsed. The brother-in-law filed for bankruptcy, and the family stopped speaking. Robert's $28,000 loss wasn't just cash. It was a chunk of his retirement and a permanent rift in his family. The worst part? He couldn't even write it off on taxes like a bad business investment. The solution isn't to refuse help. It's to structure it wisely. If you can afford to give the money outright, say clearly, "This is a gift, not a loan." No strings attached. This avoids future tension. If it must be a loan, use apps like Zelle or Loan Builder To create a formal agreement with payment reminders. For business ventures, propose investing instead. I'll put in $10,000 as an investor. If it succeeds, we both profit. If not, there's no debt between us. This aligns incentives without creating a debtor dynamic. Bottom line, generosity shouldn't come at the cost of your financial security or relationships. Protect both by treating family money like a business transaction. Because when emotions and finances mix, someone always pays the price. We've exposed 7 smart assets that secretly drain wealth. On a scale of 1 to 10, how eye-opening was this for you? Drop your rating in the comments. Your feedback shapes what we cover next.